Critical Man Pictures presents the Forex video training series. Black Belt Second Degree Trade Guide to Major Economies. United Kingdom. The United Kingdom is a land of many accents, as it is actually comprised of 4 countries: England, Northern Ireland, Scotland, and Wales. Headed by the Queen, the UK is considered a constitutional monarchy, but it is governed through a parliamentary system that is based in England's capital of London. The UK is also part of the European Union. However, the UK has refused to join the Eurozone and is adamant about using the pound as its currency. Some of the neighbors are Ireland, Germany, and France. It has a size of approximately 93,000 square miles and a population of 60 million. The density is 651 people per square mile. The capital city is London. Queen Elizabeth II is the head of state, and David Cameron is the Prime Minister. The currency is the British pound or sterling. The main imports: manufactured goods, transportation equipment, chemicals, fuels, machinery. The main exports: ores and metal, wood, food, live animals, fuels, transport machineries, and equipment. Simon Cowell and David Beckham. The import partners: Germany, the US, China, Netherlands, France, Belgium, Norway, and Italy. And export partners: the US, Germany, France, Ireland, Netherlands, Belgium, Spain, and Italy. The time zone is GMT. Economic overview. The UK is the world's 6th largest economy, and as far as history shows us, they are a force to reckon with. After all, it was Britain that started the Industrial Revolution. The UK has also had the world's largest empire back in the day, so for the past 300 years or so, the UK has been a relevant world power. Now that's what you call consistency. In terms of trade, England is a net importer of goods with a consistent trade deficit. Its largest trading partner is the Eurozone, more specifically Germany, which shouldn't come as a surprise because Germany is a stone's throw away from the English Channel. Trade activity with the Eurozone accounts for over 50% of the UK's trading activity. The US, on an individual basis, still remains the UK's largest trading partner. Not only do the British have cool accents and hotties like Kate Beckinsale, it is also home to arguably the oldest major financial center in the world. We're talking about London, boys and girls. Having a financial hub like London amplifies England's place in world trade. Here's a little bit of trivia for you. The oldest central bank in the world is the Bank of England, the BOE. Back in the day, when England was on the verge of economic expansion, government leaders realized they needed an entity to help facilitate international trade. Enter Bank of England. In 1694, the Bank of England was founded to help to facilitate trade and growth for England. Today, BOE's main monetary policy objective is that of maintaining price stability while at the same time fostering growth and employment. As it is, the Bank of England is aiming for a target inflation rate of 2.0%, which is measured by Consumer Price Index, CPI. In order to meet this target, Bank of England has been granted the magical power to change interest rates to the level that they believe will allow them to meet this target. The group within the BOE that is in charge of determining interest rates is the Monetary Policy Committee, or the MPC. The MPC holds monthly meetings, which are closely followed by announcements on changes in this monetary policy, including changing in interest rates. Like all other things British, interest rates have a different name in England. In England, the interest rate is called the bank repo rate. The main policy tools used by BOE's Monetary Policy Committee are the bank repo rate and open market operations. The bank repo rate is a rate set by BOE for its own operations in the market to help meet the MPC's inflation target. Whenever the MPC changes this rate, it affects the rates of commercial banks set for their savers and borrowers. This in turn will also affect spending and output in the economy and eventually costs and prices. Like other central banks, if the BOE raises the repo rate, they are aiming to curb inflation. On the other hand, if they lower the rate, they are aiming to stimulate growth in the economy. When the BOE engages in open market operations, the BOE buys and sells pound-denominated treasuries and securities to control the supply of money. This is an alternative method to increase liquidity in the financial markets. If the BOE feels there's need to stimulate the economy, they will print more money and inject this monetary supply through purchases of the government and corporate securities. On the other hand, If the BOE feels like the economy has enough candy, they will sell more securities, effectively taking back money from the economy. Getting to know the pound. The pound dollar is one of the most liquid currency pairs in the forex market. How come? Remember, London has been a major financial center of the world for a long time. With major business transactions taking place every day, lots of moolah goes in and comes out of London. Still, the GDP pound dollar only accounts for 14% of global trade, making it the third most active traded pair. This is probably the reason why spreads on the pound dollar tend to be a pip or two more than the euro dollar and the dollar yen. With so many big-time corporations being based in London, there are many highly attractive investments to be found in the UK market. Couple this with having some of the highest interest rates among major currencies, investors find British securities to be more attractive. In order to get their hands on these assets, investors would first need to purchase some Great Britain pounds. Pound-dollar trading volume is highest during the European session, with potential for strong moves during the New York session when key UK and US data is released. The Asian session doesn't normally provide much movement, as European traders are still in bed, while US traders have just finished their day. The pound pairs are very prone to volatile moves because of its lower level of liquidity compared to that of the euro. With liquidity growing thin at certain times of the market, the pound can get caught up in one direction, especially if there are large buy-or-sell orders in that direction. Compared to other currency pairs, the pound pairs tend to react more strongly to surprise economic data releases. Some of the economic indicators for the pound: unemployment rate. This is the measure of how many unemployed persons there are in the UK economy. Analysts look at this account carefully because it could be a leading indicator of future spending. How come? Well, nobody has a fucking job, then they don't have any money. Without any money, nobody would be able to afford tea time. Consumer Price Index, or CPI. The Bank of England looks at the account as a measure of inflation. It measures the change in price of consumer goods. The gross domestic product, or GDP. This figure reflects the state of the UK economy. It indicates whether the economy is growing and booming, or if it's stuck in the English Channel and drowning. Purchasing Managers Index, or PMI. This index surveys business managers and asks them their view of the current economic landscape. Scores above 50 indicate improving conditions, which may lead to expansion, while scores below 50 hint at possible contraction. The GfK Consumer Confidence Report. This report gauges consumer confidence about current and future economic conditions. The more confident consumers are regarding the state of the UK economy, the more likely they'll be willing to spend. What moves the pound? Many investors look at the pound for higher yielding assets and for a carry trade. Changes in the NPC's interest rate settlement alter the pound as it affects the yield of British securities. In addition, changes in the bank repo rate also reveal the BOE's outlook on the economy. If the BOE officials feel that the economy is hurting, they will either expand quantitative easing measures or cut interest rates, which will signal to the public that the economy is unstable. If the BOE feels that the economy's rise may lead to inflationary pressures down the road, they may cut back on quantitative easing or hike interest rates. Like other currency pairs, the pound dollar is also heavily affected by developments in the Eurozone and the U.S. economic data, directly affect investors and trade sentiments in the market. Good or bad data from the U.S. can either send market participants running to the pound on increased risk appetite or looking for safety in the U.S. dollar on account of risk aversion. The Eurozone accounts for a majority of the UK's trade relations. Because of this, you should also keep your binoculars ready to see any developments over the mainland. Remember, the UK is a fucking island. Any bad news or poor economic performance could potentially lead to bearish sentiment toward the pound. Albeit small, the Great Britain pound benefits from the fact that it boasts the highest interest rate among the major currencies. When traders are in search of greater yields, they will look toward the UK because of the potential of getting a higher return on their investments. When traders want to unwind their higher yielding investments and look for USD dearest, they will start selling off the pound. Some of the trading tactics. One way to trade the Great Britain pound is to look at key reports come out. Pound pairs tend to react more strongly to economic reports. For example, If the UK GDP figures were to come out much better than expected, it could lead to a massive rally in the pound. If you were to enter late, you could still grab much of the pips because the pound pairs really move a lot. Be careful though. Pound dollar and pound yen pairs are the most volatile among the majors. In fact, pound dollar moves around 160 pips per day on average. Because the pound is so volatile, you might want to set wider stop loss in order to withstand all the strong moves in the market.